Okay, sorry for the technical glitch. I think it's 17 November. It's still weekly marks. Been looking at Fred Mosley's work, which is a kind of adjunct, I suppose, to the questions that have been raised about Marx's money, Marx's theory of money, as well as emergence of modern money theory. And they're not identical. And I think that folks should sort of think about what that means, why they aren't identical. There are people who disclaim or point out the differences between the two, and they're not all that different. And I would assert from a larger perspective that MMT is there to provide the kind of policy solutions that are necessary in a contemporary economy. Unfortunately, of course, due to the recent election, we may never get there, but the idea is still there. It would be interesting to see some things modified at a different regional kind of level. Be interesting and useful for a country to actually adopt the system, the thinking about how we think about debt, for example. But back to what we're reading, Duncan Foley's book, or Duncan Foley's chapter in Fred Mosley's edited book on Marx on money. Why is that important? Well, we need a sort of historical perspective on the money system, and particularly Marx on that. And well, anyway, we'll get right back to it. Remember section number 4. Contemporary monetary systems. In Marx's theory of money, a produced commodity, for example, gold, becomes the socially accepted general equivalent. The emergence of a general equivalent is a spontaneous, decentralized phenomenon that accompanies the development of the commodity form. Currencies issued by states inherit their value from the commodity, although the standard of price, which defines the state currency unit as a certain quantity of the money commodity. For example, the U.S. Congress in 1790 defined the dollar as 1/20th of an ounce of gold. Needless to say, not quite the same. The effective convertibility of the currency through a full-weight species coinage, or the free exchange of paper money for bullion at the standard of price that ended in the 1930s, ensures that the currency prices of commodities reflect their gold prices. Marx's theory of money describes a system that was only coming into being at the time that he wrote. When Marx was developing his theory of money in the 1850s, the gold standard was far from securely established. Convertibility of national currencies into gold was fragile, with the departure of the USA from the gold standard at the onset of the Civil War, and important parts of the world maintained silver standards or bimetallic systems. While something like the system of world money based on a universal money commodity, Marx describes, did operate from about 1870 to the outbreak of the First World War in 1914, it deviated from Marx's theoretical picture. The pound sterling played an asymmetric role in the system, which was more than a sterling exchange standard than a gold standard. International currency adjustments during this period were often accompanied by sterling credit transactions and the manipulation of the British discount rate rather than through movements of gold. In the 20th century, the evolution of the world monetary system took a turn that Marx, of course, did not anticipate because he died, as national currencies severed their convertibility into gold. This was during the Depression. This institutional change was marked by an increase in the vulnerability of national currencies to chronic inflation, and eventually by an evolution of central banking towards inflation targeting, with important ramifications for the political economy of world capitalism. The inconvertibility of national currencies into gold, however, made remarkably little difference to the day-to-day functioning of markets and credit. prices of commodities continue to be set in terms of national currencies, especially the dollar, the US dollar, which appears to function as the measure of value, means of payment, and to a considerable degree, world money. The monetary expression of labor time and the analysis of the origin of surplus value in the exploitation of labor can be applied transparently to monetary systems based on inconvertible national currencies. What is left hanging theoretically is the determination of the value of national currencies, especially or particularly the value of the US dollar. In Marx's theory, the same forces determine the relative price of the money commodity to other commodities as determinate prices generally, namely cost of production and the average profit rate. The gold prices of commodities vary over time because of uneven technical progress in the production of gold and other commodities, but are determined at any moment in time. National currencies inherit this determinate value through the standard price and their convertibility into gold. With the disappearance of this institutional link, however, we seem to be left with no Marxist theory of the commodity value of national currencies, a lacuna that makes itself sorely felt in a world in which struggles over inflation and the value of national currencies play a central political economic role. While this abstract theoretical issue remains unresolved, the history of world capitalism since the demise of the gold standard presents a pretty clear picture. One element in the evolution of the value of the dollar has been the attempt of commodity sellers to peg their dollar prices. For example, in the 1960s and 70s, in advanced capitalist countries, labor unions set strategic money wage targets. Oil producers also set dollar price targets. A second element has been recall, of course, that there was discussion under the Nixon administration of wage and price controls. A second element has been the power of central banks to control credit availability and hence to influence asset prices and production financing. Permissive central bank policy in some countries adjusted credit availability to the demands of labor unions and OPEC, Organization of Petroleum Exporting Countries. OPEC tended to erode rates of surplus value when capitalist firms could not pass on higher money wages and energy costs to buyers. In the late 1970s, a revolt of rentiers, see Dumenil and Levy's book on 2003, forced a revolt of rentiers forced a more confrontational and combative stance on central banks in the form of inflation targeting policies. Central banks create credit stringency to frustrate the setting of money wages or oil prices at levels incompatible with relatively low rates of inflation. The result has been a fall in inflation, a rise in rates of surplus value, and a shift of surplus value from industrial capital to financial capital. To call this monetary policy inflation targeting obscures its effects on the rate of surplus value and the rate of profit. It might more accurately be described as surplus value targeting in Marxist terminology, or quantitative easing. In less advanced capitalist economies, the exchange rate has been the crucial mediating factor between money wage and commodity price setting and central bank policies. In these countries, a central issue in foreign exchange rate policy has been the relative impact of exchange rates on the value productivity of labor and the value of labor power. Theories of this epoch of monetary political economy have been developed extensively in the new Keynesian macroeconomic literature, or post-Keynesian, as it were, and also by Sraffians who see central banks as being able to set the rate of profit and hence the real wage along the real wage profit curve. These useful insights into monetary institutions, policy, and political economy, however, have not been well integrated into the Marxian theory of money. In the interest of working to connect these two literatures, the remainder of this chapter will be devoted to a discussion of the contemporary monetary institutions within the framework of Marx's theory of money. State credit money, number 5. Neoclassical monetary theory represents fiat money as a bubble, a worthless token whose value is sustained by belief in its future acceptability. This is the point of various models of money as an unconsumed good that solves the double coincidence of wants problem. These theories all depart from Marx's theory in regarding money as valued because of scarcity rather than because it's actually a production cost. The relevance of this neoclassical vision to real-world monetary systems is doubtful. The central confusion is the idea that because cash, that is, central bank notes and reserves, is a means of payment, the value of cash arises from the scarcity of means of payment. But unfortunately, there are close substitutes for cash as means of payment. There are treasury bills, the very secure liabilities of large banks and firms, and so on, which have high interest elasticity of supply. Furthermore, while the stock of cash is relatively fixed, its velocity of circulation in relation to the flow of payments is highly variable, and in some contexts, effectively unbounded if you look at the velocity of reserves of large New York banks. Thus, the picture of an inelastic demand for means of payment encountering a relatively fixed supply of cash as an explanation for the value of cash is really off the mark. In formal terms, cash is a liability of the central bank, and the holders of cash are lending to the central bank, or more broadly, the state. It is counterintuitive to regard the value of money as being sustained by the central banks limiting its borrowing, but this is what the scarce cash theory of the value of money seems to imply. Cash is widely accepted as a means of payment, which creates the illusion that cash is a claim on resources. But to theorize on this basis is to invert the real relationships involved. The ability of states and central banks to borrow rests on their holdings of offsetting assets. Every government has an asset in the tax liabilities of the public. For some governments, there are other important assets such as land or natural resource reserves. The stability of the USA's finances owes much to its ownership of vast land reserves, for example. It is not true that a central banknote is a valueless token, which is inconvertible into anything of value. As a liability of the government, it can be used to pay taxes. Now, a better starting point for understanding contemporary monetary systems is evaluation and management of the state debt. The dollar is not a name for scarce cash tokens, but the unit in which the debt of the U.S. government is denominated. Debts of the state are the measure of value and means of purchase and payment. Now, Marx has a well-worked-out theory of the valuation of government debt as fictitious capital. Marx explains that interest is a part of surplus value claimed by the owner of money who lends to a producing capitalist. Competition among lenders and borrowers enforces a uniform rate of interest adjusted for risk and other specific aspects in individual loan contracts. This uniform rate of interest creates the impression that interest is an inherent property of money and that any money holder subjectively incurs an opportunity cost equal to their uniform rate of interest. This appearance inverts the real relation underlying interest flows, the appropriation of surplus value from the exploitation of workers. Loans to productive capitalists are real capital. They're part of the money capital committed to the circuit of capital to finance production. But once a uniform rate of interest has emerged, any recurring flow of income will be capitalized at that rate of interest. For example, the rent of land, which is another part of surplus value, capitalized into a price of land, even though land cannot be produced. Once equity stock has been issued by a capitalist corporation, it represents a claim on dividends, and its value is a capitalization of the anticipated flow of dividends. The value of existing stock traded in this way is largely fictitious capital and bears only a very loose relation to the value of the corporate assets that it actually legally represents. Governments and capitalist societies generate recurring revenue flows through taxation. These flows are capitalized through the issuance of government debt, which promises the holder a flow of interest income financed out of tax revenue. The resulting value of the government debt corresponds to no real capital investment and hence is a fictitious capital. The fact that that cash liabilities do not pay explicit interest tends to mislead monetary analysts into regarding the value of cash as arising in a different way from the value of interest-bearing government debt. But the fact that cash liabilities pay no explicit interest is not an inherent property of cash itself. It reflects the policy of governments to contrive a situation in which the convenience yield of cash liabilities equals the interest that would have to be paid to sustain their value if they were less liquid. In contemporary monetary systems, the convenience yield of cash government liabilities is bolstered by a variety of legal prohibitions as well. For example, in the USA, the government maintains a legal monopoly of the issue of demand notes by taxing banknotes issued by private banks. The value of cash liabilities is a fictitious capital, just as much as the value of interest-bearing government debt. Hence, why we have modern monetary theory is to sort of work out why that is problematic. Since the near substitutes for cash are not perfect substitutes, at least in the short run, central banks have market power over the interest rate differentials between cash liabilities, which pay no explicit interest, and near substitutes, which are like treasury bills, T-bills, commercial paper, and large certificates of deposit issued by major banks. Monetary policy rests on this exact power. As the central bank changes the quantity of cash available through open market operations, for example, the convenience yield of cash relative to close substitutes changes. The market registers this change by altering the nominal rate of interest of close cash substitutes. This is what the Fed does all the time. The Fed is managing these kinds of operations, Federal Reserve Bank. In contemporary economies, then, a fictitious capital, the liability of the state, rather than a produced commodity, functions as the measure of value, which automatically seems, hinky in the Marxian way. The loose theoretical end in this argument is what determines the value of the currency units in terms of social labor or commodities in which the liabilities of the state are denominated. This problem is common to Marxist and neoclassical economic theory, monetary theory. The value of state liabilities and assets are uniformly homogeneous in the value of the currency unit. This point is often made analytically through the thought experiment of a currency reform, which simply renames the currency a unit. Any theory of the value of currency boils down to an assumption of some institution that breaks this homogeneity. In Marx's theory, the homogeneity is broken by the standard of price, which fixes the value of the national currency in terms of a produced money commodity. Now, this perspective raises deep questions about the relationship between the state and capital in contemporary capitalist economies. Is it purely a matter of historical accident that the liabilities of the state have come to play the role of the measure of value in the world of commodities? After all, there is no real obstacle to the spontaneous reemergence of gold or petroleum as a de facto measure of value and world money. Lord knows they've tried. The current situation suggests a remarkable symbiosis between capital and state, and calls for, yes, a unification of the Marxian theories of money and the state. Anyway, number 6, Marx's theory of money in contemporary perspective. Marx theorizes in order to understand. Marx's theory of money is necessary to understand how capitalist economies reproduce themselves. Money is an indispensable link between the commodity and value and the exploitation of labor in a capitalist economy. There's something disorienting in the realization that a key part of Marx's theory of money, the derivation of a commodity money, does not correspond to the historical and institutional realities of contemporary capitalism. So is the theory wrong in some fundamental sense, or is our reading of capitalist reality defective? One response to this dilemma is to affirm the logical coherence of Marx's argument by affirming that money must be a commodity in Marx's theory of money. The argument that Marx's logical derivation of the universal equivalent commodity is sound The argument that Marx's logical derivation of the universal equivalent commodity is sound is persuasive, but runs directly up against the observation that neither gold nor petroleum, nor indeed any other produced commodity actually serves as a socially accepted general equivalent in today's capitalist world. See Bitcoin. It is possible to save the commodity money theory by, for example, regarding current world monetary institutions as a suspended commodity money system in which the standard of price has become inoperative temporarily, but perhaps indefinitely. Certain legal and institutional effects could be adduced to support this view. Now, the USA still values its gold reserves at a standard of price rather than at market prices on paper, and the reluctance of national governments to sell their gold reserves suggests that they regard gold as more than just another commodity. But it is difficult to argue for the actual influence of a suspended standard of price on real economic and financial relationships. For instance, why did the implicit gold prices of commodities fall so drastically after the USA suspended the convertibility of the dollar into gold in 1971? Thanks, Nixon. Marx's method does not have the axiomatic character the commodity money argument seems to presuppose. When Marx shows how money as an independent expression of exchange value is inherent in the commodity form, he argues that from what actually has happened in history. So the idea that what actually has happened as a privileged position in a system of thought is a major theme of Hegel. For Hegel, the necessity of what actually occurs embraces but goes beyond the purely logical necessity of deduction. Hegel identifies deductive inference with the limited realm of understanding, which uncritically accepts the elements it observes as undifferentiated unities. See Sherlock Holmes. Hegelian necessity is deeply bound up with the actual evolution of history and institutions and acknowledges that pure thought in aspiring to reproduce history inevitably fails to anticipate historical evolution accurately. The rational empiricist adherents of the realm of understanding condemn Hegelian analysis because it offers no self-guarantee of correctly anticipating future developments. While rational empiricist arguments appear to contain this kind of self-validation, since if the laws governing the system and the elements constituting it do indeed remain invariant, it's actually possible to work out the evolution of the system. Rational empiricist theories, in fact, have no better track record of anticipating the evolution of complex systems like human society than Marx or Hegel. Thus, we should not be surprised to find that monetary institutions have evolved away from or beyond Marx's commodity money theory. Now, we can better understand the emergence of particular produced commodities as socially accepted general equivalents as a stage in the evolution of the money form. But this evolutionary process continues. The developments through which the functions of money have been transferred to fictitious capital in the form of state credit are firmly grounded in the forms of credit and inconvertible paper money that Marx's theory explains successfully. Since state credit, like land and other fictitious capital assets, is exchanged against produced commodities, though it is not a produced commodity, there is no formal inconsistency in viewing it as a general equivalent or socially accepted general equivalent in the framework of Marx's theory of forms of value. This line of thinking preserves the integrity of Marx's theory by extending it to embrace new historical institutions. It does leave a loose theoretical end in removing the production price of the money commodity as a determinant of the monetary expression of labor time. But even in the commodity money theory, this determinant operates only gradually over the long period. It also presents a picture of the world monetary system in which one national currency must take over the functions of world money rather than a single produced commodity functioning as world money. So that's, you've heard me yammer before about that. As we've seen, the predominant one national currency was already a feature of the functioning gold standard in the 1870 to 1914 period. It is quite plausible that competition between major national or regional currencies for the functions of world money will be an increasingly salient feature of world political economy in coming decades. This approach treats contemporary monetary systems through an elaboration and extension of Marx theory to account for a new form of socially accepted general equivalent. Just as Marx's theory of credit elaborates and extends his theory of money to embrace new forms of the medium of circulation and means of payment. An effort to fit contemporary monetary institutions into the analytic categories we have received from Marx, for example, by insisting on a continuing role for gold as a socially accepted general equivalent commodity, fails to address the real challenge to Marxian monetary theory, which is to understand the innerness of world monetary institutions and the way in which they express class relations on a world scale. So, this is an interpretation problem, one that we've seen have lots of deleterious effects, like the 2007-2008 recession. And of course, the solution was not fully solved. It just was sort of kicked down the road, and we've been kicking it down the road ever since. And it benefits other insanities by, for example, providing better, means of allocating money and fiscal policy, which were begun to solve in the Biden administration, and now we're going to step back into more crazy experiments with Bitcoin and a variety of other matters like tariffs. So on that bright and shining note, we end our little tape today. It's from Modern Appraisals of Marx Theories of Money, edited by Fred Mosley. The chapter we are looking at is number 2, Marx's Theory of Money and Historical Perspective by Duncan Foley. And there's other really interesting chapters in here worth considering, kind of the major lights of the current issues about Marx and money. A worthy read, and I can't remember whether I uploaded. I think it may be too large to upload for some reason, or maybe I did upload it. Well, anyway, all that being said, let's see if there's any questions or problems or brickbats. Seeing none, I will ask Joe to remove us from